Again, another question to pose. There is, as I said, a disconnect today. Will stock markets be correct in predicting what will happen in the real economy? Those are my 6 slides. That sets sort of the tone. These are some of the questions I would have. Thank you, and I'll hand it over to Lorraine now.
Hi, thank you for staying back to listen to us. Hopefully you won't be more confused after what we have to say. And I have to thank Phim for the invitation, for allowing me to speak. Just very quickly as an introduction, Standard & Poor's, most of you will know as either S&P 500 or the ratings division. And but we have to say that we've been around on the equity research side for about 100 years. And we cover about 2,000 stocks globally. Here in Malaysia, we're big participants in the Malaysian market through the CMDF research scheme. And that's where we draw a lot of our knowledge on Malaysia is based on our team here. Just to begin with, just the tone that David has set. It's true what he said. The market has probably run ahead of what we see to be the expectations in terms of valuations at this point in time. The S&P Asia 50 index is actually trading at about, it's more or less the historical high range of the PE bands, which is around 16 to 17 times. What's keeping things going, however, is that the expectation of better prospects ahead for corporate earnings and for the economy. S&P's view is that the analysts are actually have been behind the curve for the most part this past year. And what's been happening is that earnings expectations have started to move up. And as you can see from the KLCI, while the market continues, the index continues to rise, the PEs have actually been holding at around the 17 times current PE level. This is based on market consensus. So for as long as corporate earnings or the expectation of earnings keeps going up, I think there is fuel to keep the markets moving ahead, partly because, we are in a liquidity situation where globally all the central banks are printing. And where does the money go? If not the stock market, it's gone into properties, for example. And if the expectations continue to rise, I think there is support for the markets to keep going up. They may still go up anyway, but then if the earnings don't pan out, that's where the risk comes in. Okay. For S&P, our belief is that the U.S. recession ended last month, which is September. And the stock market is generally has been historically quite accurate on that. I don't know why, but it runs about 5 months ahead of the bottoming of the economy, which would make it pretty accurately, actually August, September period. Our base case scenario is that the U.S. economy will grow from here on in, but at a very slow pace. So in essence, what David has mentioned about consumption being a concern is what is actually going to keep the U.S. economy from rebounding at previous levels. Now, when we say slow growth for the U.S., we're only looking at about 1.6% GDP growth in 2010. And really the reason for that, the reason why there is growth obviously is the low base this year. But we do see some signs of bottoming in terms of housing pricing, the housing market, first-time home buyer activity is up. And so you remove that drag from the U.S. economy. So there's a big chunk of that. You have things like manufacturing retail sales beginning to bottom out. Where we probably want to see better or healthier signs are things on the investment front, durable goods, for example, from the U.S. companies. We haven't quite seen that come out yet. And of course, unemployment rate on the negative side is continuing to rise. We actually expect unemployment in the U.S. to peak at about 10.4% in the first half of next year. Unemployment tends to be a laggard number, But the pace of that, the monthly unemployment figures, I think will still continue to trigger some raised heartbeats in the marketplace going forward for the next few months, because that's still going to be a gauge of whether that recovery is going to be sustainable or just sort of fade out after a couple of quarters. The other thing also, which David mentioned, which we also agree with, is on the consumption. Is on the consumption side. It's going to take a while for things to go back to normal. Is that the Americans are not natural savers, for example. The thing is that they are actually now saving, partly because they have no choice at this point in time. So we have seen actually the savings rate go up from about 2% to 5% at the moment. The bad news about this particular downturn is that in the past downturns, the savings rate in the U.S. prior to recession is around 6 to 8%. Now they're coming from 2%. So it's an area that leaves very little room for any errors in that case. So we do expect the savings rate to go back to historical norms, which is about 8%. So what that means is over the next few years, it's very, very slow, gradual recovery on the consumer spending. So that really is a big sort of leg in the U.S. economy that's missing. So that's the reason why we expect a relatively slow growth. And that's what it looks like, the chart for that. Okay, as far as Asia is concerned, we have actually been raising our GDP estimates for Asia. Asia is where the engines will probably be in terms of the numbers anyway. Green numbers mean the increases. The red number is only for India recently because of the monsoon impact. But really, even though we've been raising our GDP estimates, most of it have been for 2009. We've not really changed our 2010 estimates, and that's because our expectation for a slow recovery in the States haven't really changed. But having said that, the recent 2Q, 3Q numbers are looking better than expected. And I think that will actually create some room. A lot of it is stimulus policy driven, particularly out of China. And for China, what will happen is we will start to see that the stimulus will peak towards the middle of next year. And then after that, we do expect the GDP to slow a little bit. But on the whole, we're still looking at about 9% GDP growth for China. Now, the China market, there's been concerns, obviously, of bubbles, etc., lending growth. The thing about it is I'll just go back to China for now, is that I think that there will still be loans growth, and what the PBOC terms as accommodative monetary policy is because the fact that they still need to fund the projects that are going on in the economy. There is also some pent-up demand on the property side, and they will continue to allow those to go through. As long as the external sector looks to be shaky, I think the PBOC will remain somewhat accommodative. What they don't want to see is too much loans that have gone into the stock market or are for speculative purposes. I think that's why we saw the correction in July, is because a lot of the corporate short-term lending that actually went into the stock market had to pull back. And that's one of the reasons. They've also made it much more difficult to borrow for second or third time home purchases. But if you're a first time home purchase, it's still quite easy to get the funding. So I think that as long as that's the policy, I think the market should be all right. For Malaysia, this is what we're looking at. We're going for about 3.5% GDP growth for Malaysia next year. Given that the recent 3Q Singapore advanced GDP number was quite strong at 14.9% Q&Q, there is a potential that we may raise or tweak up a little bit our Malaysian GDP forecast. One of the reasons for growth, obviously, is that a lot of the implementation of the special projects on the stimulus side will only flow through next year. The other thing also is that we're expecting a gradual pickup in the export sector as well to help that out on the manufacturing side. And there have been signs of obviously bottoming out there. But if you're talking about the shape of the curve, we're looking more at a U rather than a V for most part. And if you ask me what the letters mean for the U.S., our base case scenario, we call it a very lazy U or an excited L. So it's nothing much to shout about, in other words. We are actually quite bullish on the short-term basis for the stock market because we do expect a flow-through of generally positive news in the short term. starting with the 3Q results that we've seen recently. Now, analysts have naturally been a bit guarded in their expectations, mainly because the corporate side has been very guarded in their guidance. And as a result of that,